We're getting to it right away, guys. CCIV is one of my current top holding stocks, and I've got an important update on why I believe this is a bottom in the stock. And before we get to it, please like and subscribe to the channel and join our community here, and press that push notification bell so you are on the latest and will get those videos right away so you don't miss out on those golden opportunities. Speaking of, if you're not in this stock CCIV, I think you're really missing out on some diamond hands. CCIV has remained one of the highest priced SPAC stocks on the market, as anticipation still lingers for its impending merger with Lucid Motors. To close out the week on Friday last week, CCIV fell another 4.4% to close the trading day at $21.09 a share. Shares of CCIV started the week off last week with a bang when rumors began to swirl about a possible connection between Lucid Motors and tech giant Apple, who has been managing expectations of its own electric vehicle plans, nicknamed Project Titan. A merger date between Lucid and CCIV still has not been established, although many suspect, me included, that it will be announced at some point in the second quarter of 2021, and when it does, it will just explode from there, guys. The SPAC craze that has taken over Wall Street over the past year may be nearing its end as the SEC mulls over instituting stricter regulations over the shell companies. It started when the SEC suggested that SPAC-issued warrants should be counted as liabilities rather than equity, and continued when the agency proposed the SPACs should undergo similar regulation as companies that IPO. The fear is that inflated future growth numbers are not monitored as closely with SPACs, which puts retail investors at risk of being misled. On the automotive front, Lucid has reportedly announced that its $70,000 Air Pure sedan will be available for consumers to purchase by 2023. The initial run of its 169,000 Lucid Air Dream Edition has already sold out, according to the company, a sign that the demand for luxury EV vehicles is still high. In February, CCIV stock touched $65. So right now, I really just think this is the perfect time to buy in and hold. At this point, it's important to remember that the plunge isn't necessarily a reflection on CCIV or on Lucid Motors, with which the SPAC is merging. Rather, too many investors didn't understand how SPACs worked or simply didn't care. CCIV stock kept gaining even before the details of the merger were announced. When they were, and the market realized that a $60 plus price for CCIV meant a $100 billion valuation for Lucid, the stock violently and unsurprisingly fell. That's all in the past, and what matters for CCIV stock is what Lucid does in the future. To be sure, Lucid still has to do quite a bit. With 1.6 billion shares outstanding post-merger, the CCIV stock price still values Lucid at a healthy $35 billion. That's a big number for a company that hasn't yet delivered a single vehicle. But it's also a number that could, in retrospect, look cheap if Lucid can deliver on its potential and its promises, which I truly believe it can. Lucid really could be the next Tesla. There is some truth to that case, and Lucid Chief Executive Officer Peter Rawlinson has said his company plans to mimic Tesla's strategy. Lucid is starting on the high end with its Lucid Air Dream Edition, which will still have that price of $169,000. Tesla did the same with its Roadster. Lucid is bypassing dealers and using a direct sales model just like Tesla. It's developed a vertically integrated model with technology it developed on its own, unlike most car manufacturers that rely heavily on outsourcing. Lucid now has to deal with a competitor that is going to deliver in the range of 800,000 vehicles this year. Meanwhile, GM, Volkswagen, and myriad other legacy manufacturers are going big into EVs. So can Lucid top Tesla? Since the merger was announced, Lucid has tried to differentiate itself from the current EV leader. At a presentation on March 31st, Rawlinson compared Lucid not to Tesla, but to Mercedes-Benz. Earlier in the month, he said that Tesla was a high-tech premium product, but not true luxury. To hear Rawlinson tell it, Lucid might well top Tesla. That's not to say the CEO is criticizing Tesla. In the presentation, he noted that Tesla was 5-6 years ahead of the competition in terms of efficiency. But Lucid believes it can pass Tesla, measuring efficiency via miles per kilowatt hour. In this model, kilowatt hour essentially is the EV version of miles per gallon. The Lucid Air should see 4.5 miles per kilowatt hour against 4 for the Model S and under 3 for models from Jaguar, Porsche, and Rivian. Simply put, Lucid thinks it can manufacture the best electric vehicle out there. Since the pandemic turned the world upside down, a new category of investments became particularly prominent: pre-revenue companies. Their upside potential attracts spectaculars looking to put their money to work. This explains the excitement over CCIV, the reverse merger that will turn CCIV stock into shares of Lucid Motors. Lucid Motors piles its trade in one of the most popular business segments, electric vehicles, of course. And if you ask any analyst, chances are that person will tell you that EVs are the future. No matter your transportation preferences, it's hard to deny the viability of this thesis. Sure, EVs are exponentially cleaner running than combustion engine cars, but even if you take out the environment component, EVs are much more convenient. For instance, they don't require the costly regular maintenance that petroleum-fueled vehicles do. Plus, you don't have to pull into dirty, smelly gas stations any longer. That's a big plus for arguably most drivers. And because EVs check off multiple must-haves for the modern consumer, Lucid Motors attracted investors despite its aspirational status. However, being a pre-revenue company draws huge questions now for CCIV stock in light of the global supply chip shortage. I've talked about this before in my NEO videos about this chip shortage going on. And the pandemic imposed a perfect storm on automakers. First, virtually every industry shut down production when the coronavirus started raging across the world. The natural assumption was that consumer demand, especially for high-priced products, would be weak. The assumption was incorrect as demand skyrocketed. But production can't be turned on and off like a spigot, and this is where CCIV stock does become problematic. We do want to talk about the risks here, but while automakers are scrambling for whatever chip supply they can get their hands on, some companies are forecasting some great news for 2021. As a pre-revenue company, shareholders took management's word that it can both build production and a consumer base that will purchase those units. Neither task is easy, but when you're coming in relatively late to the game against an established dominant player, an outside disruption like a supply chain crisis can be a cruel headwind for CCIV stock. As I'm recording this, CCIV is just below $20, and for my strategy, I am buying this dip here. I really do think that Lucid Motors will disrupt this EV industry, especially in the luxury market. I do believe in EVs as a whole, and this is a company that I strongly believe in. So, guys, I think you're missing out if you're not getting in on this stock. Take it or leave it. Comment down below if you plan on adding CCIV shares to your portfolio or if you're holding some right now. And that's all the time we have for today. I'm Scarlett from Miss Money, and thanks for watching.